People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Welcome once again to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and each week, Charisse and I just sit down here and go through some of the headlines and then go to your headlines. What is it in your life that you're really concerned about when it comes to taking this step into retirement? Do you have the person with you that is going to walk this journey with you? Do you think you have enough money? Do you have a good idea what you want to do with Social Security and Medicare? Oh my gosh, there's so many questions, and that's why we meet here every single weekend. Charisse, how are you doing today?
I'm doing great. I'm ready for it not to be 50 and 47 degrees in the morning when I'm walking. So I think we might be officially out of this here very soon. And so I'm looking for summertime and taking this pasty skin and getting a tan.
Yeah, I've been watching. So last week was the Arnold Palmer in Orlando, and
Yes.
boy, they were out there the first couple of days in 30-mile-an-hour winds and stocking caps and coats and everything. And I go, is this really Florida? What's going on here? So yeah, looking forward to some warmer weather for sure.
You know, March is this a month where we always get one more cold, and a lot of times it's right on spring break. So spring break, it depends where you're going. It could be really ultimately cold.
Well, we got some cold stuff happening in the stock market right now. Boy, we have been all back and forth. And I can tell you, Charisse, you and I have been doing this show for 12 years now, and I have my nose in the financial headlines every single day. And I can tell you that if you want to find a story that's going to tell you that the market's going to just blow up and go crazy and rocket ship up to the moon, you can find that story. And if you want on the same day to find a story that says we're going in the tank and we're going to sink like a rock, you can find that story too. But I got to tell you, over the last week or so, almost all the headlines have been very, very negative. All this business with the tariffs and the uncertainty of the president. Warren Buffett is out there calling Trump's tariffs an act of war. Barbara Corcoran is saying if these interest rates don't improve, housing is going to sink. I mean, there's just one after the other. So I want to ask you this. We have new people come in. That's why we have this show. And they come into you, and for that very first meeting, what if somebody's looking at you right now and saying, Charisse, I'm going to retire in 2 years, and I just don't like what I see right now. What am I supposed to do? How do you calm them down, and how do you talk them through a time like this?
Bye. Oh, I'm far from a fear monger, everyone. You all know that. Okay, so buying is important when markets are down, but buying the right stuff is also very important. So, Kramer the other night was just talking about government, if they could just tell us in a softer version what the plan is, that would help us not be so restless, right? And Wall Street doesn't like uncertainty. So, and we do know that we all agree that there's a lot of waste in the government, and there needs to be some trimming, but just some direction and softer blows, right? Because, we don't want to upset the entire world of apple carts, right? We do want to make diligent decisions. We want to bring back America back to the way we need it to be, lowering our debt, more job opportunities, all that kind of stuff, right? All the headlines out there that is important to us. But we also have to take a defensive role, right? So Trump's taking a defensive role. Here at our office, we do take a defensive role and work on best strategies during times like this, because there's a lot of fear mongers out there, Randy.
Yeah.
Right.
Yeah.
And I had it personally. I've had a bunch of reviews come into my office that reviewing our clients' portfolios. They come in annually, and that's what we do. Some people come in more than annually, but they're not worried about the headlines. And actually, I'll tell you two separate types of people who came in. One of them said, Sharice, we have this part of our portfolio that's 100% equities. I am a little bit nervous about the noise, but you have all this other stuff baked into this portfolio that I know I'm going to make money here, and I'm not going to take losses on some of these dollars and some of these dollars over here. This bucket, we could have, we mitigate the risk. And then we got this other high flyer bucket that has my Amazons and Teslas and all that. Do you feel like, Sharice, I have too much in that bucket? And I said, no, I don't. That is our long-term bucket that we're not even going to tap into for at least 10 years. I said, but what we could do is take a third of that bucket and put it into another wrapper where if the market goes down a certain percent, we can make money. And if the market goes up, we still make money. And then when all this noise kind of dissipates, we can go back into that really, really strong type of long-term growth portfolio. And I said, does that make you feel better? He went, you know what? I actually would, because I'm just getting to a point that I want to make money for the long-term bucket, but I'm emotionally, with all the noise out there, I'm having a harder time managing that at home. And I went, okay. That's what we did. They were super happy. I had another client come in and said, Sharice, you have cash here. I know you're ready to buy. And I went, for you, we're buying today. So we bought some stuff that was on sale. So everybody is a little bit different. And it depends, really, it's dependent on your income. What kind of income do you have coming in? We take inventory every time clients come in. Has anything changed? Did Social Security go up? How much? Did this happen? Did this go out? Did your expenses change? But the biggest thing is taking inventory is, do we have that Social Security check? Do we have a pension? And if you have a Social Security check and a pension, then you probably don't have to live on your money right away. So you can probably manage this risk a little bit better. Maybe not. You could be somebody who's like, Sharice, I don't care what kind of income I have coming in. I do not want to lose 20% in a portfolio. Then that's okay. There's always a plan for you also. But if you're living on just Social Security and you're living on an IRA or 401k that's in the market, yeah, you're probably very stressed out right now if those dollars that you're living on is in the market. Because you know, as well as I know, that as the market's going down, it's a cardinal sin to pull money out of an account, right? You can do it in the short run, but you don't want to do it for, 8 to 12 to 24 months. That erodes a portfolio. So all the listeners out there today, if you are concerned, that just tells me you don't have a plan. Therefore, there's not confidence. And those people who are confident and you're thinking, no, this isn't a worry, that means you probably have a good amount of income, or maybe you don't understand what's going on. But most likely you have a good income and you got things buttoned up. And my hard, fast rule, Randy, is this. As long as you have cash flow that can pay your income needs for the next 5 years, that money does not have to make 6, 7, 8, 9, 10, 12%. Mm-hmm. That money should be making 3 to 5%. We want those dollars to be safe so that every day, every month when those paychecks come in, it keeps coming in. It doesn't get derailed because the market goes down. And whatever you need after that 5-year mark, you invest that in the market if you feel confident doing it, because you don't have to worry about where that income's coming. So again, we do things a little bit differently here. Every scenario is different when people come in. Nothing is cookie cutter here. And I do want people to know that there is a lot of noise out there. There are fear mongers out there. I am not predicting if the market's going back up, going high flyer, chasing that rocket ship again, or if it's going down. I just know this. There needs to be more than just a 60-40 portfolio strategy inside of what you have planned. There needs to be other buckets, other alternatives, and it needs to be well worked. And, we got to take a scalpel to your plan just to see where you're at. And if you are the 60-40 portfolio, I'm let me show you some other things that might really work for you too. So.
Well, I think you have said to me 100 times, listen to your gut. And if it doesn't feel right to you, then that's a sign. And so if it bothers you, if it keeps you up at night, that there's money that's going out right now. I mean, the NASDAQ just got into correction territory. That means it's, down 10%. And you look at how much you've lost. If that's uncomfortable to you, well, that is a sign that you need to sit down with Sharice and say, let's readjust my risk level and say, I don't want to lose this much. I don't want to be at the mercy of the stock market for the next 20, 25, 30 years. So let's sit down and talk through that. Give us a call. Give us a look on our website. Easiest way to do this is go to zinniawealth.com, ZINNIA wealth.com. There's a gold box in the lower right-hand corner. It says complimentary retirement consultation. If you click on that, there'll be a place for you to put in a little information information, then our team will reach out to you, or you can bypass all that right now and just call us and you reach out to us. 833-368-3680, 833-368-3680. Well, we have talked about Tony Robbins, and he's got a book called Money Master the Game. He's written a lot of books about money, and he's been talking, as he gets older, a lot about retirement lately. And he talked about the 401k. A lot of times he talks about fees, but this time he said this: the 401k has potentially hurt Americans' chances to gain wealth. He sees some warts in the 401k, and he said you need to use it correctly. So he gives you 3 ideas here. Number 1, just save up to the match. After that, it's up to you. If you have a Roth 401k, go all in. And then he says if you have both, use both, but I have some questions about that as well. Sharice, the 401k, I got to believe that most of the people that walk through your door, that's where they have most of their money. Are they using the 401k correctly? I feel that if we didn't have it, I don't think a lot of people would save. I don't think a lot of people in their 20s and 30s and 40s are going to go out there and develop a Scott account or a Schwab account, and they're going to go, all of a sudden become a day trader. That just doesn't work. So most of us are very simple. Put the money in, talk to me in 20 years.
Yeah. No, there's some value to that, because that is absolutely right, because bad behavior comes from no behavior, and no behavior is more bad behavior. And Tony Robbins, I know he listens to my show every once in a while. He should really pick up my book sometime, because everything he says, we have said over and over and over again over the last, I don't know. What are we on? 12 years?
12 years, yeah. Coming up on 13.
He's like, dang, that girl, she's so right. I'm going to have him on my show one day, you guys. I'll mark my words. Yeah. I might be 80, but we'll see. He'll be like,
we'll get him.
I need to get on a show. Let's try that, girl. So anyways, 401k. So I love a 401k because of what they are for. You're right, Randy. If a company is going to offer you a 401k and you're picking jobs and another company does not offer you a 401k, I'm probably going to go with the company who offers the 401k, because you can put a little money in based on your paychecks, and then hopefully that company will match you. It's like getting free money. So 401ks, though, they turn into this massive ticking time bomb in the future. You have this major debt that you owe, and you have a partner in your 401k, and it's called Uncle Sam. And 40% of that 401k you saved for, let's say you saved $1 million, you can basically say close to $400,000 to you, your surviving spouse, and your heirs is gone. Yeah. So that is what he's talking about. And that is an absolute true statement. So I do say, if you only can get a 401k at your employer, only contribute up to the match, the free money they're going to give you. Okay. Any dollars that you can save thereafter, I would go get a Roth IRA. Like, you can come into us, we can do a Roth IRA, and you can put money inside that Roth IRA every year. There's a limit to how much you can do. And then if you make too much income, we're in over 100,000 and lots of change, you can't contribute to it. So there are some rules. But let's just say you go, all right, Sharice, so my income's a little too high. I'm put the money into the 401k up to the match. What is the next best strategy? The next best strategy is a brokerage account, because a brokerage account, when you're in retirement or even in your younger years, is more tax efficient than having a 401k that's going to be taxed at a higher marginal tax bracket, as long as tax brackets continue to go up and the taxes go up, assuming all things, that is typically what happens. The brokerage account, you can do tax loss harvesting. We do it for our clients every year. You can take income without, paying taxes if we do that, and 8 out of 10 times. And then if you do have to pay taxes, I'd rather you pay 15% capital gains tax versus 22% marginal tax rates. So I like that strategy. You go with your 401k up to the match, get a Roth if you can, or get a backdoor Roth, which is something we'll talk about one day. And then the remaining money, get a brokerage account, right? So that is one thing that you can do. But I do want you to ask your employers, well, you got this 401k. Do you happen to have the number 2 Tony Robbins is talking about here, the Roth 401k? Because every dollar that you put in goes into this Roth, and it grows tax-free over the next 30 years of your life. It's amazing. And then the matches can also, from the employer, go into the Roth. But the difference is that you don't get a tax write-off. So let's say you're making a salary of $200,000 and you want to put $25,000 into your 401k. Well, you get to take that $25,000 off your income. So that $200,000 is now $175,000. But if you put that $25,000 into a Roth 401k, you don't get that extra write-off off your income. So sometimes there is a time and a place for a Roth, and that we do a lot of Roth conversions once people are in retirement and they typically have a lower income. That's a good time to do it. So again, it is not cookie cutter. I tell people this all the time. It's a one-on-one conversation we all have to have with you to see what works best for you. But I do love the Roth 401k as an option, because you might be somebody who's like, Sharice, okay, I'll do the 401k and then I'll come in and do a Roth with you and then I'll do a brokerage account. But if you are somebody that says, I'm not going to do that, Sharice, then I want you to save. No matter what, just save. Just know you got a big partner of Uncle Sam and the big ticking time bomb, because your $100,000 is going to go to $1 million one day, and your $1 million is going to go to $2 million one day, and then you're going to owe a lot of taxes, and so are your kiddos and your spouses. So there's so many ways that you can do this, but de-risking your taxes is a big part of what we do here. And we want to make sure that you are making those decisions on how much to go into your 401k and then how much to go into a Roth and how much to a brokerage account. Because even though you don't understand it right now, you're really going to understand it when you retire. And you can ask all the retirees that are retired today, like, I wish I would have done that. They always say that, by the way.
So if somebody is listening to us and they're in their 50s and 60s, and you know as well as I, there's some fat 401ks out there. There are people that have $1 million, $2 million in a 401k. Would you look at them and say, you have enough in this tax-infested bucket of money? Now it's time to move over to something else, be it brokerage account, be it a Roth 401k, be it your own personal IRA. Do you say at some point that there's enough in that bucket and that's going to cause us a lot of problems later, so let's move someplace else?
When people come in with $2 to $3 million in a IRA and 401k, I absolutely whip out that tax plan and show them their future. Mm-hmm. I will show them over the next 30 years. If you do nothing and you just live off this IRA and you take your required minimum distributions that Uncle Sam says you have to take, and then you pass this to your spouse, and then you pass this to your kids, well, here's the big tax bill based on today's taxes, not what the taxes could be in the future. And then I show them, what if we took $3 million and we rolled half to an IRA? How much does that change your tax burden over the next 30 years? It is an astronomical difference, Randy. And then we'll show you, what if you did it all, right? And it is an astronomical difference. There's hundreds of thousands to millions of dollars left in a tax-free status to beneficiaries, depending on how much you have saved. I don't know anybody else that has a software that can show it the way that we show it, but a lot of people are always wondering, well, what is the difference? How can I see that? That's what we're going to provide you when you come in. We do need your tax returns, though, your most recent one, of course.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth, and most of us will go into retirement, and our biggest asset is going to be that 401k. If you're working your way there now, is there a point where you kind of look and say, I've done enough here, now it's time to put it in a different bucket? Well, what is that bucket? Well, let's sit down and talk through that. Give us a call at Zinnia Wealth, 833-368-3680, 833-368-3680, or go to zinniawealth.com and hit the box that says complimentary retirement consultation. That's a free meeting. We'll sit down and talk through your concerns. And maybe it's all about your 401k and Social Security and taxes. Let's get all of that out on the table and get your questions answered. Again, zinniawealth.com, and hit the gold box that says complimentary retirement consultation. All right, there's an article in MoneyWise that says baby boomers make up 21% of the U.S. population, but they have 50% of the nation's wealth. Oh, you greedy baby boomers. Okay, so it says here,
baby boomers.
but when I think about this, it says that many baby boomers have a real priority to make sure that they pass money down to their kids and their grandkids. But there's a new trend happening here because of the high cost of inflation, the high cost of living, the high cost of retirement, that many baby boomers are saying, you know what? I'm going to hold on to my money. I'm going to stay in my house, and I'm going to make sure I'm taken care of. And whatever is left over, that's fine. That's fine. So
I love that strategy.
Yeah, I do too. They're a little bit unconcerned about passing down wealth. As a matter of 40% of baby boomers don't have a will. So they're that unconcerned about it. But yet, if you talk to their kids and their grandkids, 50 to 60% of millennials and Gen Xers are saying that an inheritance is critical or very critical to their financial security.
Oh my gosh. Parents, your kids saying that, spend your money because they're not going to do a better job. That is, all right. So
what do you see it? What do you see it?
Oh my gosh. I just hate that 50 to 60% of the millennials and Gen Xers are expecting the legacy because I've already heard a few times that they're traveling and they're retiring earlier and they're spending more money because they know that inheritance.
Mini retirements, taking a year off and we never did that.
Yeah, no, we didn't know. And, it hurts the economy, number one. But number two, it's just lazy thinking.
Yeah.
And I would prefer the parents to spend their money if the kids are thinking that.
Yeah.
But there's plenty of kids out there that are like, no, mom, dad, spend all your money, right? And they're usually doing pretty good, whatever they're doing mostly. And or they're just, they're good kids. They're brought up right and life is life and kids are kids. But I do believe that inflation is important and it is costing the retiree, they're on a fixed income, more and more money every year as things keep going up. So they are worried that, hey, if I got 20 or 30 more years, do I have enough money to cover this inflation thing? And then healthcare. I mean, that's an 800-pound gorilla in the room. There's all these baby boomers who, need their Medicare, need their healthcare. And so I think we're going to see some issues in the future on that. So that they're worried about their healthcare. They want to make sure that they get good care and it's not going to cost them an arm and a leg. And then they worry about long-term care planning. Like, who's going to take care of me? Or I have the money if I go to a nursing home, and then will my surviving spouse have the money if they go to a nursing home? Is there going to be a legacy? So I will say this, that it is prudent for retirees to consider working on a will and a trust, a power of attorney, a healthcare surrogate, and a DNR, do not resuscitate. I think those are responsibilities of a human being, number one.
Yeah, don't neglect it. Don't neglect it.
No, if you have kids, you should be doing these things. Yep. I mean, when I first had my kids, I went out and got my will and trust, right? I got it all set up. And then I adjusted it, and I keep changing it, right? So I think it's important to spend your money during your go-go years and front load that retirement and do everything you can, because there's going to be a day you cannot. But if you're on a trip and then something happens to you and we front loaded your retirement, but yet you don't have the will and the trust, you don't have things set up, it can erode your portfolio at the end of the day, because attorneys, that's their bread and butter. They'll earn 5 to 10% of whatever goes through probate. So we need to have those things. And I even think you should have those things, especially a special trust, because if you want to rule from the grave, then get a trust that says for those kids who are expecting a legacy and are enjoying their lives and not putting any work towards the economy or themselves, maybe you have a special trust built out saying, hey, you're not going to get all the money. To get any of this money, you have to have a job. And when you officially have a job, then maybe you can have the interest from this trust, but you're never going to have the principal. If you want to control from the grave, some of you are like, nah, I'm just going to give it all to him, not even worried about it. And there's special trusts out there that you can set up. But really, the important thing here is getting your will set up. Make sure your stuff is going to the right people. Depending on the state you live in, it can go to the wrong people. Every state has their own rules, but get that will. Who's going to get my NFL ring? Who's going to get my couch? Who's going to get my high heels? Who's going to get my Rolex? Who's going to get my $5,000 cappuccino espresso maker that hits the button for me when I wake up in the morning, right? So it's nice to have those things set up. And talk to the millennials and Gen Xers and your grandkids and your kids, period, and to say, hey, I've got this money and I'm going to spend it. And sometimes them knowing that they're not getting anything is probably the better strategy because it'll help them think a little bit differently and not have that expectation. And then whatever they get, they get. So come in and see us. We'll talk about the will. We'll talk about how to set up the power of attorneys, healthcare surrogates, and talk about the trust and different types of trust. And then we'll coordinate these sit downs with our attorneys because you need to know, because anything can happen and you want your legacy and estate passed on the way that you want it passed on.
It's all a part of the retirement planning process, and it's something certainly that we want to deal with. And to do so, give us a call, 833-368-3680 or zinniawealth.com. Click on the gold box that says complimentary retirement consultation. We're going to take a break, and when we come back, of all the years that Sharice and I have been doing this show, I have never seen Congress actually sitting down and talking about the future of Social Security. What are they talking about, and how does it affect you? We'll get into it coming up next on Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, ZINNIA wealth.com. That's our website. Tool around there. Find out more about Sharice. There's a button there. It says complimentary retirement consultation. If it's time to talk about your retirement, click on that and we'll get that going. So, Sharice, here it is. I've got good news. I got bad news. Okay, you ready? Okay.
Ready.
So the good news is NASA was telling us we're going to get hit by an asteroid in 2032. And the good news is we've dodged the bullet. The asteroid is going to miss us. We are going to continue on. There will be no repeat of the movie Armageddon right here, right now. Okay? That's the good news. But if you look at the year 2032, there is some bad news there, and that's one we've talked about an awful lot. That's about the time that the insolvency of Social Security is lurking out there. That's when the trust fund dries up. Now, that doesn't mean that Social Security will end, but it does mean that if nothing is done, that means your Social Security check could be cut by 20%, and some say even more. So right now, Congress is looking at a number of different things. They've talked about putting an extra tax on higher earners, which could boost the trust fund. It could boost monthly payments. It could set the program on solid footing for another 75 years. They've talked about moving up the tax base. Right now, it's, I think, 12.6% that you pay and your employer pays, and they're talking about moving that up as well.
Don't do that.
We really haven't had any meaneful Social Security changes since the Reagan administration. It's been over 40 years.
It's annoying.
Yeah, something needs to be done.
It's hurting us.
Yeah, something needs to be done. So let's talk a little bit about this because I did hear, I talked at the beginning of the show about negative headlines. With all of the layoffs at the Social Security Administration, the person who was in charge of Social Security, who is now outgoing, has said that he thinks that in the next 30 to 90 days, there are going to be people that are going to be missing their checks. So that's a concern. So
I don't understand that. How do you miss a check? Isn't it all electronic?
Well, they won't go out because there's not enough people handling it. So they've...
like real checks.
Yes.
Okay, roger that. I forget. Some people do get real checks and they don't get it put into their bank accounts.
Right.
Got it.
Just people handling the money and how it goes. So there's
Don't we have artificial robots and all that for that nowadays?
They actually have computers. They have computers that are running on COBOL. And I mean, it's just ridiculous how outdated our government computers are. So
well, maybe they're testing out AI, Randy. Let's flip the coin, and they're going to blame it on the robots. Just not tell us to see if this works. Maybe there's a reason now. Okay, let's get back on track. Back to Social Security.
So back to
I am
Social
worried
Security.
about insolvency problems.
Yes.
Okay? So let's talk about that.
Everybody's worried about that.
Yeah. So if 2032 Social Security has gone into some insolvency problems, well, guess what? Yeah, everybody's Social Security checks that people who are collecting could go down 20%. That is scary. I mean, think of the inflation going up. The baby boomers are already saying, hey, I got to hold on to my money because of inflation and long-term care and all this stuff. And then all of a sudden your checks get cut 20%. I pray and I will write letters to Congress trying to help them make the best decision to make sure that doesn't happen. But they're going to do what they want to do. But I'm going to tell you, the average retiree, 20% could be massive.
Yeah.
Most people, if your checks get cut 20%, you need an average of an extra $800,000 to like $1.4 million saved in another bucket. Do you have that extra bucket you're not pulling from right now that you could live on that difference? I mean, that if you have 30 years left to live in retirement, that is massive. I like to look and see this glass half full, that this won't happen. There will be a plan. Randy, a year ago, we said we need to stop kicking that can down the curb and something needs to happen. But yet still nothing has happened. And the 2 years before that and 4 years before that, I can go back 8 years ago when I was adding these Social Security conversations to our workshops we do at these colleges. They're saying the same thing. They're still kicking the can down the road.
And that is one of the things that I think will happen. I think Congress doesn't move until they're in the 11th hour and their backs are against the wall and people are outside with their rakes and their torches going, fix Social Security. And they'll finally do it. You know, something that I was thinking about in my own life, Charisse, and this is, I think, such a simple solution, okay? So I'm supposed to, my retirement date is 3 years from now. And Julie and I pay off our mortgage 5 years from now. So that puts an extra $1,200 in our pocket. So without doing anything, just paying off debt, it gives me more money. And I don't have to go in and say, where's this money going to come from? I'm just paying something off and I'm putting that money in my pocket. And that should handle the problem that Social Security may have in my future. So it doesn't have to be real complicated. It could be something as simple as that.
It can be something as simple as that. But I hate that those dollars would have to replace your Social Security check when you could be using those dollars to gift, travel, all the other stuff. So yeah, you got a backup plan, of course. So that's your backup plan. But I know that's not your real plan. You don't want that to be your plan. That's your spending plan. Those are the dollars you're looking forward to because you've done a good job being a good financial steward of your life by getting it paid off, because that's what we need to do before we retire. And then now, because the government put their sticky fingers into the pot, now it's eroding your plan. You're responsible, but they're not. So, you know, cat's out the bag. Government needs some cutting. This is what they're doing. We just need to make some moves on Social Security. And I'm not sure not taxing Social Security is the right direction either, because if you're worried about insolvency in 2032, that's going to hurt us a little bit more. But I think there could be Social Security credits based on age, based on if we're a widow or widower. So there's so many things out there. I could probably get up there and solve a lot of problems.
I like
Randy.
that idea. I like that. I like you on the hill. I like that idea.
They don't know best. I don't know what's going. Oh yeah, I could take them down. You're worried about Trump? No. I will tell you, it's simple math. It is basic economics, and the government does. I feel like they just don't understand basic economics. But now that Trump's in office, maybe we can come to a better solution in economics. But just Trump, stop trying to scare the tar out of everybody and tell us what the plan is and soften these blows a little bit so we can see the math and we can see the trajectory.
So one of the things that also comes to my mind on this is we talk about the idea of Social Security planning. And we say, you know, hey, if you take it at 65, 67, 69, 70 years old, and you have to weigh all that stuff out. And then if you're married, there's all sorts of things that you have to think about there too. But Charisse, when we talk about delaying our Social Security, if you were going to take it at 66, and you were contemplating waiting until 70. And the difference there was a $2,500 check to a $3,000 check. Right there, you're putting yourself in a better position. If they cut the benefit back, you've already maxed out your Social Security, and that has to work in your favor.
Yes, let me tell you about somebody who just came in. I can see the vision of what I painted for a client that came in, and they came in. They weren't collecting Social Security yet. Husband and wife were going to wait till 66 to take Social Security. And the wife said, Charisse, why can't I collect at 62? Like, can I? It would just be really nice if I could. and so we took their income plan and we rejiggered it from Mr. collecting at 66, but then Mrs. collecting at 62. And we ran it for 30 years. So they're in there, I think 90, 92, right? Okay. 95 years old. And at the end of the day, the bottom line, the big thing that changed, it was their assets. And we assumed a very pessimistic rate of return with an inflation rate of 3% over those years. And what it did is it took them from a $2.7 million asset in their portfolio to a $2.4 million asset. And I said, does taking Social Security give you that much peace of mind by collecting at 62? Because the big change at the end of the day was $300,000. So that means if you both die in your early 90s and we have this pessimistic return on your portfolio with a reasonable rate of inflation, it looks like if you're not going to miss out on 300 and you want the Social Security, then take it. But how in the world can you make that decision if you don't see what I'm building out or what our advisors are building out for you? It's key. And then the husband's like, well, Cherise, let me do mine. And I said, okay. And we ran his at 62. And it did make a much bigger difference because that Social Security check he was collecting was over double what the missus was collecting, right? And then I said, well, what if one of you pass away earlier? Now the smaller Social Security goes away. How much more does that erode the portfolio? So there's this medium point that we have to get to, that happy medium. And so we worked it out and we changed our plan. And after they've been working with us for 4 years, I wasn't expecting to do it, but because she asked, we reran the numbers. I'm like, it's not going to be that bad because their portfolios have been performing well. We've had all these strategies. So we have more money than we expected 4 years ago. So that's the great news. And to be able to bob and weave and see this is what the consumer, this is what the individual should be seeing to give them confidence in what they should do or not do. Because if you hear all this noise, how do you know when to collect? Have you done the math? So come in and we'll do the math for you. And we love doing it. And it's such a fun experience.
If you take the Social Security early, then you got to do the math to see when does this pay off. If you take Social Security late and then you dip into your 401k to get there, then what does that mean? And then, if you take Social Security early, and you can't pass that on. Your Social Security check is not an inheritance, but your 401k is. So that's a consideration too. So there's sure a lot to think about and sure a lot of math to do. And that is what Cherise says every single show. Let's do the math on your retirement. And there's a lot of math to be done on your Social Security. Let's figure it out. Let's give you the options. Let's find out what you feel comfortable with. Here's our number and here's our website, 833-368-3680. Let's have a meeting and do the math on your retirement. Do the math on your Social Security. There's a gold box on our website, zinniawealth.com, Zinnia wealth.com, and it says complimentary retirement consultation. When you click on that, we'll ask a little information there for you, and our team will reach out to you, and we'll get a date on a calendar and talk through this. Again, zinniawealth.com or 833-368-3680. At the same time, I want to talk a little bit about why people come to see you and when they come to see you. We talk a lot about risk. People see the stock market going topsy-turvy and they get a little antsy and they wonder, what should I be doing about this? But most of the time, that starts about 3 to 5 years before retirement. That's when people really start looking at their accounts. There's a new article in Kiplinger that says you should begin that process 10 to 15 years before retirement. That seemed early to me. There's a lot that can happen in the market positively and negatively in 10 to 15 years. Do you think that that's too soon? Do you back off on risk that soon, Cherise, with somebody who's 50 years old?
Let me ask you a question, Randy.
Sure.
When you get to a stoplight, before you get to the stoplight, if it's yellow, what do you do?
Some people hit the gas and they go flying through. Other people go up, slow down because it's going to turn red.
Right. And then when it's red, what do you do?
You have to stop.
Okay. And when it's green, what do you do?
You go.
Right. So it's the same thing with retirement. There's this retirement red zone, and I just call it the zone, retirement zone, and I call it 10 years before. I think 15 years is a bit much. I mean, it can't hurt to work with an advisor if you would just want some tips on some tax strategies as you're deciding a 401k or a Roth IRA or something like that. But when it comes to retirement planning, I would consider 10 years out. Let's say you're 55 right now and you want to retire at 65. I would call that the green zone. You're still in the green zone. In that beginning phase of that green zone, yes, I do think 10 years out, it's good to have your first conversation with an advisor, somebody locally, whoever you end up choosing, and just start that conversation. Because there might be things that at that very point that you could work on over the next 10 years. You just might need some advice on, hey, I need to save more. And I've saved $500,000. I'm trying to figure out a way to save more. We can help you with that. Or you might say, hey, I got $1 million and over the next 10 years, I want to take part of this 401k and roll it to a Roth. So we want to talk about those things if you have that much time. But the green zone is keep the metal on the pedal, because a lot can happen over the next 10 years. But then, then we hit that light. I call it the yellow light. We're yielding a little bit. That is 5 years before retirement. I want you to not continue hitting that metal to the pedal. Like there's that green light and you can keep on going. 5 years before you retire, that is when you are really in, I call it the red zone of retirement. You can make some really big changes at that point. You might have a couple old 401ks that need to be rolled to IRAs or consider the Roth conversion. There's another strategy that's really important that you should be working on, because you've been growth, accumulation. And let's say the market's doing good and you're in this 5 year zone before you retire. And you just said, no, Sharice, screw you. I'm going to keep the metal on the pedal. We're going to go through this green light. And then all of a sudden, year 4, 1 year before you retire, the stock market crashes and your $1 million, that 401k is now 201k because maybe you lost 50%. Are you still going to retire if your $1 million went to 500,000? And the answer is no, you're not. You're going to continue working and you're going to have to wait for that bottom. And then you're going to take 4 to 5 years for it to get it back to even, to get that $1 million back there. So that's why that 5 years, that yellow light, that yellow zone is so important for planning, because we're your guides to get you to retire on that day you want to retire. And the interesting thing about that 5 year zone, well, we end up finding out when we're doing these income plans, we found out those people who are going to retire in 5 years. We find out based on what we do in our income plans and the written plans, they can retire now. They don't even have to wait 5 years, or they can retire in 2 years. So it's just the perfect time period, 5 years before retirement. And then the red zone, I mean, this is the hot zone. That is 2 years before retirement. That is the red light. Stop, get your brakes on. You better get in here. You have a short window. You need to make the best decisions you can be making. And if you think you should have 100% of your money in the stock market, think again, because you want to be able to retire in 2 years. So a lot can happen in 2 years. So, hot, brakes, the red light is there. So I like to relate it to the yellow light, green light, and red light strategy, because 5 years out, get in here. It's life-saving. 2 years, I don't know why you're waiting. 10 years, you have a little bit of that green light. You can still keep going, but start considering that conversation with an advisor. 15 years, I think, is a little early.
Well, the greatest commodity that we have is not necessarily something financial. It's something called time. When you're in your 20s and 30s and 40s, you got a lot of time till retirement. When you're in your 50s, now you got to start thinking about that clock is starting to wind down. Can you recover? If you lost 50% and you're in your 50s, can you get it back? You probably can. You probably can. But in that yellow light period and that red light period that Sharice is talking about, you might not be able to. I mean, it took us, 7, 8 years to get back from 2008. It took us, 17 years to get back from 2000 and 2008 before we got back to normal. So there's a lot of time in there that needs to happen for that market to recover and for you to recover as well. So this is something to sit down and talk to Sharice about. Whatever area you are in, you need to talk about what that does to affect your risk analysis, and that is certainly one of the big things we're going to talk about at Zinnia Wealth. Give us a call. Give us a look on our website. Here's our number, 833-368-3680. Again, 833-368-3680, or ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box that says Complimentary Retirement Consultation. Click on that, and you'll be on your way. All right, this is a little bit of an update on a story that we've been following for quite a while that I want to make sure everybody knows about, and that is we've had Secure Act 1.0 and Secure Act 2.0, and we've talked about all of the different changes in retirement planning for those. In Secure Act 2.0, they said they were going to add annuities into our 401ks. Now, show of hands, how many of you have seen that? Nobody. Okay, so it's just starting now, okay, years later. BlackRock is one of the first companies to step up and offer an annuity inside their 401k.
I wonder why.
Yes, I know.
I'll tell you why in a minute.
Okay, here's how this one works. First of all, you allocate some of your money in your 401k to a target date fund. Starting at age 55, a portion of that money goes into an annuity. At age 65, you are then given the choice. Do you want to use the annuity, or do you want to just put it right back into the target date fund and use your 401k like everybody else? That's where we're starting.
This is the stupidest thing I've ever heard of. Of course, BlackRock's first in line. Let's find more ways to screw people and charge them more fees. Dumb. Let people invest the way they want to invest. Don't force them into annuity and then give them an option to get out. How confusing and messy is this going to be? Yeah. Because during those years, you need to have growth, right? Mm-hmm. And what these 401k companies are doing is, they got rid of the pensions because they didn't want to be pension managers. They didn't want to be liable for your income because they didn't think they could manage it well enough and then have to claim bankruptcy and now get your entire pension. So now they came up with the 401k thereafter, which is fine. But now they're coming back and they're like, no, let's bring the pension in. Let's make you liable even more. Let's charge you more fees. Let's be more dumb. Sorry, you guys. I had to look. This is so dumb. I don't like using those words, but this one, I didn't even see this one coming, Randy. Good job, buddy.
That's funny.
Listen, do not get an annuity in a 401k. No. Come talk to me first. Okay. I know there's TIA CREFs, and the TIA part is the annuity, and the CREF part is the market. I get that. That's a different strategy. I don't like that one either. And it's the biggest complaint to known man, that TIA part of that TIA CREF account, for those who knows what I'm talking about. So if you get that opportunity, I just say buyer beware. See if there's another option. Come talk to us. We'll even talk to your administrators and see if there's another option so you're not forced into something like that. And maybe they're just testing this out, but this is dumb.
Well, one of the things that we've talked about a lot is we use these employer-based plans to save money, and that's probably a good thing. That it forces us to save. It gets you to a point where you've got some wealth so you can use it for retirement. But once you get to about 55 or 60 years old, then it's time to start to say, okay, how do I use this money and take it into my own control and do a privatized kind of thing in your own best interest? Because your employer plan, now that pensions are gone, were never meant to fund your retirement. It just really isn't. It's up to you now. So take that into your own hands. And I mean, Sharice, we talk every week about how we need to sit down and talk through what we have and build it into a plan that's going to work best for us.
Yeah. And I'm going to tell you, there's thousands of annuities across the country. Mm-hmm. In my opinion, there might be 10 good ones out of 1,000.
Wow.
So what's the chances of BlackRock getting this right, or anybody else? It's a fat chance. Like, literally. If there's only 10 I would touch with a 20,000-foot pole out of 1,000, there's a problem, Houston. So there are some good ones out there, but there's a whole lot worse ones. And this is starting like the worst of the worst.
All right.
Anyways.
So the final word on today's show is, if you see an annuity in your 401k, don't jump to Sharice and say, what do you think? And then look at the options there, right?
Mm-hmm. That's right.
Well, that is all the time that we have on the show today. We want to make sure that you can give us a call and you can throw anything our way. You can bounce that 401k office and take a look at what the options are there. You can take a look at what the market is doing right now and throw anything you can at Sharice and what your questions are about retirement. That's the main thing. Let's get them answered. 833-368-3680. 833-368-3680, or our website, zinniawealth.com, ZINNIA wealth.com. Hit the gold box that says complimentary retirement consultation. We'll get a date on a calendar and go from there. Sharice, that is all the time we have on this one. I'll give you the last word.
Well, thank you all for tuning in. If you want to hit the rewind button, go to our podcast on your Apple phones or Spotify, iTunes, YouTube, wherever you look at it, and listen to it. And you'll be able to hear what we had to say this week. We talked a lot about Social Security and tax planning and baby boomers and all that jazz. Wills and trusts. Pretty good show today. So again, we appreciate you all. Live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.